How's it going, everyone? RoyalFlush here. Welcome to Meter Management, Not Financial Advice. As usual, don't fall for any of the spam in the comments. And any of the information from this video is not advice to buy, hold, or sell any stocks or crypto. So take some good notes. Let's have some fun. No worries, no hurries. Okay. So today's subject is cash secured put. It's also called sell put. It's an option strategy where you are willing to buy 100 shares of a specific stock at a certain price of your choosing, and you get paid premium to do that. But in order to first give you an understanding of how it works, let's go ahead and take a look at this. I'm sure you've seen this before. You've seen these before, right? This is an eBay auction. So typically in eBay auctions, you try to buy something that you know is expensive, potentially at a lower price, and you can do that by placing a bid. And it would use, I mean, obviously though, because you're bidding against other people who want the same item as you. And as you can see there's also a buy it now option. Usually, that's probably as close to the retail value you can get it. But maybe the seller's giving it to you for a good deal, but the idea is you're basically trying to get something for a lower price. Disregard the fact that the price of it's just going to continue to go up. But when of course, when you're bidding for something, you have enough money for it, and you're willing to buy it in full, but you're hoping to get a nice price. So hopefully this idea here will transfer over nicely when we get into the stock part of things. I mean, obviously, if you made it into this video this far already, you already know what you're in here for. Why would you want to run a cash secured put? Basically, you could buy 100 shares of a stock that you like at a discount. Instead of dollar cost averaging into it straight up, you could also say you have a large sum of money that you're willing to buy into a stock and you want to make a little extra. So it could go two ways. You could either pick up the 100 shares of a stock that you actually were willing to pick up anyways at the price you wanted at a discount, or if the price of the stock itself continues to climb up instead, well, then you just got free premium. So it actually does work both ways. It really should be a stock that you're bullish on, and by bullish I mean that you are willing to hold it and assume that it's going to go up at some point in time. There's basically two things to it. It's either you get the shares, 100 shares at a discount, or if it expires worthless, you get to keep the premium without even having to buy in the close. And that's another thing. These cash secured puts, while you can buy to close them, I actually just recommend, personally speaking, I actually just let them expire with worth or worthless. Because if you're already willing to pick it up, I'd rather run covered calls trying to go up than continue to run cash secured puts going down. But if you tend to like this style of picking stocks you like and hoping you get them at the price you like at the discount, you can continue to do cash secured puts. Let's go ahead and talk about the risks. I want to be careful of running a cash secured put going into earnings, because that's going to bring the IV of it really high. IV is the implied volatility, and so what that means is the value of the stock itself is going to have a high options premium. So that actually might be good for you if you're just going to agree to the cash secured put, but it could also be very costly if the stock continues to drop right after that earnings report, or if any event in whatever way, shape, or form continues to make that stock fall. But if you, again, assuming that you have already set your strike price and you're not going to buy it to close it, it could make it so that if it does get exercised, your cost base is going to be really high. That might be very detrimental, because say you have a high strike price, but the share price dips way below it, and now you have yourself a stock that you hold 100 shares of, and it was not discounted. It was you basically bought it for way more than it should have been. So it can backfire. And sometimes, honestly, dollar cost averaging is just a smarter way to get into it. But if you're comfortable with running cash secured puts, then it really shouldn't matter to you if you get picked up or not. So I think the defining factor of it is you shouldn't really want to buy the close unless you are like certain that things might go for the worse and you're better off just buying the close. Again, I have a special rule, the 3/4 rule of buying the close on cash secured puts and covered calls. I have here my portfolio. I've ran the cash secured put on a few stocks, but I want to focus on game stocks because this one was one that was actually quite favorable for me. I'm actually currently running a covered call on it as part of the wheel strategy, but now what I want to do is focus on how was it that I picked up GameStop, because I have exactly 100 shares and my cost average is $29.50, and the reason for that is I already had $2,950 ready to go to pick up 100 shares of GameStop, but I was hoping to pick them up at a discount. And ultimately, I did, because by the time of expiration for this contract was up, the closing share price for GameStop on the day of expiration was $28.90. So if it was a $60 difference from my strike, I got the cost of the shares for about $133 discount. That's basically what it was. So let's go ahead and open up what a cash secured put would look like for GameStop specifically. So you would go to sell put. Now don't let the name confuse you. Even though it's called sell put, what's really being sold is the contract. When you're selling options, the value of the contract is actually the reason why you're getting paid. It's not necessarily that you're selling, you're exchanging collateral. The value of the contract itself is actually what's being sold, not because you're actually, the action of you buying the 100 shares is a result of the option contract becoming worth. So let's go ahead and look at GameStop's current share price. Current share price. This is for tomorrow expiration, mind you. You can see here it even though it's a same week expiration, it has a really nice spread. It's just a matter of how much you would want to get paid. So for my example of how I got picked up, I had $2,950 here, and that would be ready to go. Let's go ahead and look at the profit analysis chart. So assuming you want to do a cash secured put, you have to determine whether you want to buy at the money or if you want to buy a little bit below the share price. Because if you're trying to do this for premium, you have to go. I would recommend doing it at the money or slightly above or slightly below. You don't want to do it too far in the money, because even though what you see here is technically the difference between the actual share price, because literally see here, look, this is $30 and this is $220. So if we take this premium here plus the current share price, it's it adds up. The distance is pretty close, or it's pretty mathematically distant for what you're getting for the awarded in premium here. So how would you initiate a cash secured put? So basically how I got mine here, I had just this one here. I had $2,950 ready to go, and currently this one is in the money. If you look here at the profit analysis chart, the green means as long as you're in the green, I mean, you will have maintained the profit. But if the share price ends below the $29.50 by expiration, you have to buy at that price regardless. So you did get paid in premium when you, at the time you had written the option contract, but regardless of whether the share price continues to go to $17 or anything below your strike 20, you have to buy it. So that's why you want to know where's a good area to buy this, to be willing to buy 100 shares of the stock at. So always keep that in mind. I recommend doing a bit of charting. If you wanted to do a bit of charting, you can look at some levels on GameStop as to where it might actually work out for you in your favor. GameStop did have a split not too long ago, so you have to take that into account. So 29.50, you can see it's pretty reasonably a solid level of resistance. So with me being comfortable to pick it up there, I was pretty certain that it wasn't gonna go too high up in share price. So you wanted to be I wanted to be somewhere near it. So this right here, that's 29.72 is a pretty solid resistance for it. But let's go ahead and look further back. So you see here, this 29.70 right here, yeah, that's going to be a pretty strong level of upside resistance. So I consider this to be a pretty strong level. Let me go and make sure it's showing up here. There it is. Okay, good. So I consider this level to be a pretty strong level to choose a strike price at. So either you just choose your levels nicely, or you already just determine a price that you're willing to pick it up at. As far as expiration date, I recommend maybe about a week or less. So by less, I mean even like by a Wednesday. Even by the Wednesday would just be fine, because you want, if you're okay with just continue to pick up premium, then you want it theta to be beneficial to you in that you have to put up a lot of collateral to make this contract make enough premium for you. So, but at the same time, if you want to just be in it for the premium, you would want to buy deeper into the money, because the premium is already higher. But again, you run the risk of having a higher cost basis in the event the share price dips way below it. So you want to be careful of that. If you buy out of the money, that means like even further away from the stock in the down direction, you will collect less premium, but there's a better chance that you'll be able to keep it. So on light covered calls, where you want to buy an out of the money strike on the upside, this one would benefit you from buying an out of the money cash secured put on the downside. You can see there's quite a few expirations here. But if I wanted to choose an out of the money GameStop put, sell put, I would look somewhere near wherever the resistance would probably make it bounce off. So that's when we look at our charts. So that was today. So if you really wanted, you see there, that low of the day was 26. That would probably be a pretty decent area to pick up or set your risk at that level. If you're willing to pick up the shares at 26, then it would be a pretty solid area. Let's go ahead and look at the 26 strike. So you can see there on the $26 strike, this was actually for today's information, so it might change by tomorrow when market opens up. But if you had written that on Wednesday, which was yesterday, you would have gotten about anywhere from $15 to $23. So that's not too bad. That's a pretty solid premium for being willing to pick it up at actually a really nice discount. But if you want to be a little bit closer to, if you want to pick up at getting nice premium, that's when you have to pick at the money. So if you go for the at the money strikes, well then you're going for $100. Personally, for me speaking, if you have enough collateral for these sell options, I like somewhere around $100. So at the money would be perfect, and either below or above it. It's a matter of, do you want the more premium and more likely to get exercised, or do you pick slightly less premium and run the risk of actually evade the risk of being exercised at a high dollar value. So prerequisites for performing a cash secured put: you must own enough buying power as collateral for the exact amount for the cost of 100 shares at the strike price. So if you have at the strike price you choose, just multiply that number by 100. You need to have that amount. Okay, so that's the first step. Secondly, you want to write your strike somewhere at the money, and maybe at support if you can, because if you're buying it at support, then you're setting your risk very low, and so in the event that it drops below, well, now you have a decent support. And if it continues to go up high, well, then now you just collected a nice chunk of premium, and you can actually redo the cash secured put. This is assuming you like to do the cash secured put for premium. Thirdly, you want to determine if you want to buy the deep in the money strike price for the higher premium. You run the risk of buying the stock way higher than you would need to, versus buying the out of the money for less premium, but you're less likely to get exercised. Again, you shouldn't worry about buying the closies because these are stocks you're willing to pick up anyways. Fourth, you would want to buy maybe somewhere from a week or less in expiration. So if it's the same week, like 2 days before expiration, you can do that. But just be very careful of earnings, because the high implied volatility will make so that selling options on it will actually be very beneficial if you're trying to collect premium. But just know that you also run the risk of it backfiring in the event that the share price dips way low. So you want to be very careful. And lastly, I would recommend doing these on red days, because you want to pick it up near support. Because if you are running the wheel strategy on this, you want to go take it somewhere high, right? So that's why I recommend doing this on a red day or when it's very close to critical support. So I think the easiest thing about the cash secured put though is that you don't need to monitor it nearly as much as you do a covered call, because your intention should not be to buy to close it unless you really want to and set a better strike price. You want to let it expire worthless so you can really run the wheel again and collect full premium. But also in the event that it gets exercised, you pick up the 100 shares anyways, because you are already comfortable buying it anyways, right? If you're new to options trading, I highly recommend selling options before you start buying them, only because it's stuff that you already own. You either own the 100 shares of a stock, or you have the enough buying power to afford that. So basically the same way as you were to buy something on eBay, you have enough money to buy something that is worth a lot, but you might actually be able to get it for less. And that's why if you are comfortable with buying 100 shares of a stock at that price, then run the cash secured put. You might actually like that it does benefit you if nothing happens, but if it shoots up, you collect the premium, and if it shoots down, well, you can just tell yourself, well, I was willing to buy the stock anyways, it's not so bad. So in the event that you do get a discount, that's an extra plus. So always do your homework on your stocks before you start playing them. Just because you can wheel a stock does not necessarily mean you should wheel every single stock you get into. You should really understand their price movements before you commit to it, because one of my mistakes was actually buying into every single stock and then not knowing that they were just going to dip lower and lower and lower. So I had to set really, really bad strike prices just to be profitable on them again. But now that they've fallen to such good support, I could buy them for cheap, and I don't feel bad running the wheel on them because I know they're near such low support that it's so strong. So if it's going to climb back up, it's not going to do it very quickly, but I can continue to collect premium on it. So if you're starting the wheel and you know your stock is at really low support, or really, if you know your stock that you're interested in is in really good support, and you know it's gonna come back, then that's when starting with the cash secured put is actually pretty nice. So get comfortable with it, and then you can start determining whether you want to run the cash secured put more than just dollar cost averaging. Okay, so I think that about does it. Let me know what you guys think. Is the cash secured put something that you would like to do, and would you like to do it on a stock that you're already willing to buy 100 shares of? You guys let me know in the comments below, okay? But as always, let's take it easy. Stocks is fun, but you're not gonna do it overnight. You have to understand that there are many strategies in stocks, and I think the one that's weird for people is to understand that while it's not always just up and always down, you can also play options that are slightly neutral but benefit the upside, or slightly neutral but also benefit the downside. Cash secured puts, much like covered calls, they are slightly neutral, so if nothing happens, it's fine. But if it goes down, you're willing to pick up the stock anyways, and if it goes up, well, you collected yourself some premium. So you should always consider that options isn't just the way you're trading. It's also, well, because I'm trading the options, regardless of the outcome, it is favorable to me. So that is what you should come comfortable with. With selling cash secured puts, you are really choosing your cost basis ultimately, and that is smart, because when you're doing that, now you know where to set it above or below. So if you become comfortable with running the cash secured put, it is a vital part of the wheel strategy. I am going to make a wheel strategy video. It is actually one of my main strategies, and maybe it might become one of yours. So please look forward to it. I'll catch you guys in the next one, but before you guys go, in order to earn it, you're going to have to learn it, and in order to get what we desire, you're going to jump to the fire. Take it easy.